What's going on, guys? Welcome back. SmartHelpy.com here. I've got a nice financial model professional services slash agency. I've come across some really useful logic. It's kind of like a little bit like SaaS, software as a service, or recurring. Um, but the logic I've got here, I finally found a nice business to apply it to that really will help startups in this space. So what I'll do is go through each tab, explain all the assumptions, and then you'll know how it works. Now note this is just arbitrary numbers I have in here. If you were to purchase a template and use it, you would put your own assumptions in. And note, it doesn't. Everything in here is not. You don't have to have it. Like it's got room for investor funds. It's got spaces for debt. Um, but those can be zeroed out if it doesn't apply to you. If it does, then you can use it. Uh, so here we go. Tab 1 is the control tab. This is where you're controlling some of the environment, like the date range. So you'll put the first day of the year that you're starting the forecast in. The model is going to go out 60 days, or not 60 months from the first day of this year. So right now I put in, 1/1/2020. And so the whole model will be across from 2020 to 2024. You can plan out the exit, or you don't have to. But if you do, you could pick the month that the exit happens. From any months after that, the whole model will zero out. And then what will happen is the valuation is going to use a EBITDA multiple. Uh, in this type of business, it uh, it might be more useful for an EBITDA multiple rather than a revenue multiple, and you'll see why when we get into it. But I've just done an annualized EBITDA multiple based on whatever the EBITDA is for the given month of the exit. So that's just annualized multiplied by this, and there's your exit value. Now, like I said, you could put NA here, and the model will run through 5 years, or you could pick a month, and you could also zero this out. Um, We've got sources of cash, so debt, if you're going to do a traditional loan, you get funding from a bank and pay them back principal and interest over time. The model will assume that if you do pick an exit month, then the whatever debt is owed at that month, based on how much principal you paid off, will be paid out. Um, then we've got investor money, proceeds. You could determine the percentage they get, and that's just some simple math here, implied valuation. Then you've got, based on the debt and investor funding the model will look at the cash in and out every month for month one and give you the minimum value. If it is negative, it'll show up here. And all that means is after the investor money and debt proceeds, there's still not enough money to cover all the planned expenditures and startup costs and everything. So then the net left will be filled in here automatically. Now, if this isn't off, let's say you got 600,000 from investors, this would go to zero, and the remaining 25% of profits that have not been given to the investors would just flow to the owner side. But you can see the distributions once we get to that. So that's the control tab, just some high-level assumptions. Next is the revenue tab. This is the most interesting. So I was really excited to apply this revenue logic because I've never done it before. It's unique and I think it's super powerful. It allows for smarter forecasting, more accurate, and I think it's got a wide use case here. So so first of all, professional service or an agency. This is for like an accounting firm, a law firm, uh, marketing firm, any business where you have a bunch of people working for clients and they're charging those clients billable hours, and the firm or the agency is taking a cut of whatever is being paid um, for those hours, and then the professional that's doing the work is getting the rest of it. So this is a business model, and first of all, the first assumption here is the number of professionals you have at launch. So this could be zero if it's just a startup, but if you're already got going a bit, you might have some amount of professionals going, and if you do, you put that number here. Then for year one, you determine the amount of professionals you plan to hire per month. I just put an arbitrary number here, 1.5. It doesn't have to be a whole number. It's a forecast, and it's actually more accurate with decimals because that means you're thinking, well, you might hire between um, 1 and 2 professionals a month. You don't know, so 1.5. It's a probability, and you can run all the numbers off of that, and it's actually more accurate than putting 1 or 2 if you think the number's closer to like hiring one person um, or hiring basically 3 people every 2 month span in this case. So in 2 months you would hire 3, um, and so on. Then we have a percentage improvement here. So this is just saying, well, if you hire 1.5 in year one and you're growing by 25% in the amount of hires, then in year two you're hiring 1.88 people a month, and so on. To help better understand what this number means, I put a couple metrics here, like the months it takes to add one professional. So based on adding 1.5 a month, it's going to take you 0.7 months to hire one. So you're hiring more than one person a month. So what that means is just that honestly, it's just the inverse of the 1 point. It's just one divided by 1.5. Uh, and it goes across to here. If you're hiring 3 a month, then you're hiring one every 0.3. I've also done it by week, so hire per week. If you're hiring 1.5 a month, that means every week roughly you're hiring 0.4. If it was bigger numbers, it might make more sense, like 10. Then you can see 2.5 hires a week. Um, and then also the weeks it takes to add one professional, 2.7. So every 2.7 weeks, roughly, you're hiring somebody new. And you can put in whatever numbers you plan on having here for your forecast, and all this auto updates. This will also be a main driver for your monthly cohorts of new professionals added and their quota attainment and everything else we'll get into. So we've controlled, or we're forecasting how many people we're hiring. The next section I have is I've put in 3 pricing or 3 types of professionals, and I've just put, for the sake of um, simplicity, low, mid, and high. So you might have some people that bill out at a lower rate, some at a mid, some at a higher level on average. So you can account for 3 different types of basically billable services. You can pick the start month that they begin, and as well as the percentage for each new hire. Like here we hire 1.5, 20% is going to be low, 30% mid, 50% high. And again, decimals is fine. You can have half people, person and a half, because all it's truly representing is the probability of that many people. And it's actually more accurate to have a decimal than a whole number, even though it doesn't, intuitively make sense right away. It's actually the most accurate way to do the forecast. Um, so you can just define what they're billing per hour at each type, and that can change over the 5 years as well, or it could be the same for all 5 years. Now, you'll notice interesting logical conundrum that I've solved here with the percentages. So let's say you start in March of 2020, and your low starts March of 2020, but your mid, you're not. Now, this is probably more of a rare case, but let's say you don't plan on bringing those people until May, and then these high people, you don't plan to start hiring them until like September. But you've already defined the percentage you want each new hire, or however many new people you hire. You've already planned out that 20% going to be here, 50, 30% here. But in March, these 2 tiers have not started, and you don't want to just take 20% of 1.5, or else you're not hiring enough people as what you wanted to do here. So the first logical step in our model is actually looking at the percentages in each month and then doing an actual percentage calculation. So if this is 20% and these two are 0, you're actually going to 100% of the hires are going to be low. And then when you start to add the mid here, you can see in May we added the mid. It's actually going to take 20% divided by the total percent here, which in this case is 50, and you end up with 40% low, 60% mid. So now we're not leaving out any of these new hires because of the logical issue. And then finally, when we get to the full in September, we have all three types going. So this is now going to be divided across three and added into our tiers here, which we will get into in a minute. So there's revenue, there's how much of each new hire is in each tier, the pricing. Now we have quota attainment. So this is another nice logical piece that I've done in the template. So you can define how many hours each professional that you hire is planned to bill out every month. And you could change it for each the low, mid, and high tiers. And you can define the percentage of that quota that's attained based on how many months each hire has been active for. So there's a bit of a ramp up, and you could actually have this stretch out for any amount of months. Eventually, though, it should reach 100%. And then here's the numbers for the billable hours per month per type of professional. And it's just based on this percentage attainment here. Now, to make all this work, we have to track, well, how many professionals are hired in each month because they're obviously going to be hired over time. So I had to do 3 matrices, one for the low, one for the mid, one for the high. All the logic here, we had to do a bunch of sets to make sure, like, so the first one is tracking how many hires you had. So say month 3, we start with 1.5, and then we have attrition. So we have, and this we're skipping a step, but this kind of flows into what we're doing. So we're going to say we also want to account for the fact that professionals are going to leave the firm. So you can put the average amount of years you think each, on average, each type of professional is going to stay with the firm. And based on that, you have some amount of churn and some monthly churn. So this is saying over 8 years, if somebody joined, they're likely to be gone within 8 years. Now you don't know when they're going to be gone, so you have to do averages again. So we're going to see decimals and percentages that aren't, even, which is fine. Mathematically, it works out great. So basically, you're saying there's a small 1 in, well, how many months is in 8 years? There's basically a 1 in that many months chance that they're going to be gone. So you actually take that away from their count, the actual count of them. So let's say in month 1 we have 10 people, and let's say they're actually, the tenure expected for that group is, or for that type is 2 years. So that's 50% a year, 4% in a month. If we go to our matrix here, look at, remember March is the first month, so the third month down we've hired somebody. And now look, how many months are those 10 people going to exist for? Well, should be 24 months. You can see here, count 24, month 3 to 26, including 3 and the 26, and counts 24, and then you're now, that whole entire cohort that joined is gone because of the useful, or the expected tenure of this professional service type. And every month in between there, you're slowly getting down. You're saying, well, we don't know, but we think, in the first 12 months, maybe half of them might leave, and then the other half, if the expected tenure is only 2 years. Now, likely in these kinds of businesses, it's probably going to be higher, but you have to do research on that to figure out what numbers make sense for your organization. And there's no explicit right or wrong here, but in my opinion, I think these should be pretty high, the years here. I think the churn's relatively low. So you won't see, they'll still be active. They're not going to be zeroed out within the 5 years of the model, which is fine. But we can accurately show the probability that they're going to be dropping off, and that will reflect in the revenues and everything else. Now let me see if I didn't get backed up here. So we've got, okay, so we've got that kind of ties into quota attainment because now that we know how many of, so the 10 people that were hired in um, month 3 are different from the 10 people hired in month 4 and so on, month 5, 6, 7. Um, so what we want to do, and you can see why this is going down from 10 to 4, is because now in May, the 5th month, you've got 30% coming into mid. So now the 10 is now split down into um, partial amounts because you've got some people being hired for those. Which again, I think it's rare. I think normally you'd have all these set at the same month, most likely. But if not, well, you can account for that. So you've got, it's back down to 2 that I just adjusted. So you've got these 2 people, month 4, these 2 people joined, month 5, these 2, and so on. And each month a new group joins, they're not going to be as efficient as earlier groups. So if we go down here, we're counting, this logic dynamically counts the amount of days that a given monthly cohort has been active, and it starts counting. This count does 2 things. Number 1, it allows us to, well, basically does it tracks where they should be on their quota attainment. So if we keep scrolling down here, you can see the amount of hours they're billed is actually 17, which is just taking the days active, looking up what that equals for the quota. So if they've, or months active, so if they've only been active for 1 month, they should only be attaining 20% of their quota. And that number equals the 20% times whatever the quota is for low, mid, and high, which is different for each of them right now. So that 17 is going to apply to the total people hired in that month. And then it goes in now month 2, they're getting higher and they're eventually getting to their, and then 100% is 85, which you can see is here. Let's say you change that to 95 on the matrix, it would dynamically change. Now you can see they get to 95. So that's what this matrix is doing essentially. And then we can also track churn because in the top here, starts to go down every month after um, a given cohort is hired. And we're simply looking at the max of the previous months times the monthly churn in here to calculate this. And you're losing the proportionally the same amount per month. So every month you're losing 2 times this percentage of 1%. And eventually that goes to 0. And once it does, the logic knows that and it zeroes out, and that's it. And we can aggregate all that together to create churn and head counts for all 3 types of levels there. So really cool stuff. Um, really excited to get this out. I think this is going to be super useful, and I'll keep going through the model. You'll note that this is probably the most complex part, but it's the most necessary to do this the right way and to be, smarter with the forecast. So yeah, I think we covered everything on the revenue. The quota, we covered the cost. This is just standard, basically like your operational costs, the CEO, COO, CFO, general managers, all these other fixed costs. You can pick the month that you plan on them starting. Um, and again, this all ranges based on the start month put on the control tab. And then you pick the monthly, all-in salary for each of these people. You could also have, rent, whatever it is, you're putting the monthly amount here, and then that could change over time, so you could change it in each year. But no matter what, the start month that these values start popping in at will happen only after the date that's entered in column C here. I've also done some variable costs. So in this type of business, you might have cost per professional. So this is saying like, what's the cost per professional for coffee a month? So it's saying, hey, what if it's $10 a month? Ongoing training, licenses, lunches, whatever you think the firm would be paying out per month per professional. This is where you can account for that, and that'll all aggregate on the monthly detail. So that's pretty standard, not too complex here. The CapEx and other, same thing. This is just one-time future expenditures that are not like operational, so expansion of the office, computer upgrades. You just pick the month you think is going to happen and the amount, and that'll show up in the cash flow summaries. One-time startup costs are going to be what you're spending before any operations happen. So this is um, things that are not accounted for here and not accounted for on your general fixed costs. These would be like, buying a building, initial website building, vehicles, office furniture, signage, marketing, whatever. There's a whole, and whatever you have to spend money on to get the thing going, that hasn't been already counted somewhere else, so you'd put in here. And this always shows up in year 0 of the forecast and that's got to be funded by either debt or equity or both, or combination. So well, we're kind of going backwards here, but you'll see eventually after all that stuff aggregates on a monthly basis and annual basis, and then we can show distributions like, so the project is going to return some amount of cash. It's going to use some of the equity that's been put up over time. If there's burn for a couple months, which just means the expenses are higher than the revenues, which is typical for the first, couple years, usually until you get some traction going. Um, and then we can break this into the project IRR and discounted cash flow. Then we could split that between the investor and owner based on the percentages defined on the control tab, and see the discounted cash flow valuation for both investor and owner. And this is all dynamic based on whatever you end up putting into your assumptions. Executive summary showing the main line items. So you got revenue, cost of goods sold. In this case, your revenue is actually total billables, and then your cost of goods sold is the amount of money you have to pay your professionals, obviously to do the work, and then the difference is your gross profit of the firm. You've then got your fixed and variable overhead costs that gets you down into your total operating costs, and then your EBITDA is going to be the gross profit less those total operational costs. Um, and then from EBITDA, we can do, a percentage margin, debt service coverage ratio. Then we have other cash flow items that fall outside of operations. So CapEx, debt service, investor funding, company funding, which is owner's equity, startup costs, proceeds from the exit, if there is an exit here, um, loan proceeds from the funding, and then paying back the loan whenever there is an exit. And then you get a final cash flow amount here at the bottom. So let's see. If we walk from that through, there's some summaries here for the project, for the investor and the owner, equity multiples, ROI, IRR, total cash return against the investment, some key just revenue, gross profit, EBITDA over the 5 years here. And I've got like 20 visuals that I'm going to go through in a second, but let me get to this. Okay. So this is where obviously you can see the aggregation of how many people are hired per month, the percentages that those hires are making up of the different types. Then you've got the detail by professional type. So the low, you've got people, the starting count, the hired, churn, which this churn is going off the matrix, which I showed you all the logic that's going into that. And you get a finding ending count of the professionals in the low tier. Then you've got their key metrics. So, how many total billable hours they're doing, the value of that, how much is going to the firm, how much is going to the professionals, the average earnings per month per professional. So that's taking the total billables divided by the total count of professionals for the month. And then you've got average hours per month per professional billed. So, and that's going to eventually get up to, it's going to approach um, the quota, which in this case I think we put up to 95. We'll put it back down to 85 right now. So that will eventually build up to 85. And that just means, the people coming on are making up a less and less percentage of the total people. And so you're getting less and less diluted. You're basically just approaching the limit of your quota cap at this point as you get further over. So this is done for the low. Same thing's done for mid and same for high. And that's all dynamic based on the months you choose each one to start here. Starting count, all these numbers all flow into that dynamically. Then we get total professional headcount of the whole firm. So this is how many people are working for you and billing hours to clients. Then from there we can get our total revenues, total cost of revenues, which is paying the professionals, gross profit made by the firm, gross profit margin. Then here's the monthly cost of all your different fixed operational costs, the variable cost per month. Then you've got EBITDA. So again, the structure is similar to like the executive summary. It's just this shows the detail of how everything is being calculated. And we get down to CapEx, debt service, all the different other cash flow items. Uh, we just some advanced metrics down here like total monthly billable hours across all tiers, total monthly billings across all tiers, average billing rate. Um, So that's the monthly summary, and it's got things here on the side so you can hide like some of these big fields. You can hit the button up here. If you hit one, it'll hide them all, so you can just see the main line items if you want. The annual tab does the same exact thing as the monthly, but it's just on an annual basis. You'll note that um, the counts. So this is just saying basically the year-end count, the total added, the total lost, the year-end count of each type. And then you can see the billings that they've gotten over the year, annual earnings. Basically the same thing as the monthly, just annual basis here, and all the way down. And this will feed the executive summary and distributions tabs. And then you can also see the annual billings, annual billable hours, and then so the annual tab is kind of cool because now you can see like how much each professional is making per year on average. So the high people are making 240. Eventually getting up to their max or approaching what their quota would result in them making if they fulfill it 100%. Mid-level, they're doing 125. Well, they're doing 196 to 500,000, and then low is 94 to 260. So really, really interesting stuff here for if you're trying to run an agency, start an agency, running a CPA firm, law firm, whatever, where you have people billing out time. This is a great model to try and get a hold on the financials. The visuals, so here's a bunch of the visuals: cash position after equity, new hires per month, monthly cash flow, cumulative professionals by type, non-stacked. So, I had a spelling error there. So non-stacked means like the low any count is 64, mid is 156, high is, here it's 300. This is not stacked. Excuse me. So this is not stacked. So it's not like the total count of professionals that you have is what this top line represents. Like it's each one is individually. Now this one on the other hand is stacked. So the top bar here is actually your total count of professionals, and then each bar represents how much of the total each one of these represents. So like this takes up this much, so it'd be like from 300 to 800, which actually equals this total here. Same thing for this, but this allows you to see the total and then how much of that total is made up by each different professional type. So that's nice to see the ratios kind of in a visual block. Annual cash flow. Yearly revenue generated for the firm by professional type. So this is how much each professional type is, what revenue they're generating, and you can see the proportion. So this is stacked as well. So this is the top bar here would be the total of all three types. Here's a total professional head count. So this number, this here would follow this top here. Same trend, same numbers. You see it gets to 800, 800. It's just this shows the total without breaking it into individual types. Average monthly billings earned by professional type. Average annual billings earned by professional type. Um, Average monthly hours billed. Average annual hours billed. New hires per month by type. Billing versus billable hours per month. Across the board. So this is across the whole firm, what you're making per month in hours and what the value of that is in total billables. Average billing rate across the firm. Then billings versus billable hours per year. So this is the same thing as the monthly, but it's just showing per year instead of per month. Then I've taken some more financial metrics, EBITDA per year, expenses by type, which is obviously the cost of goods sold in this case is huge compared to everything else. Um, but it'll depend on whatever your assumptions are. Debt service coverage ratio. So, well, I guess that pretty much explains what is going on here. If you want to purchase a model, I'm probably going to list it at $75. I think that's a fair price. That's my intermediate level price. Honestly, this is probably, it could be easily valued at the upper tier pricing at 125, but I think there's enough volume that it justifies me lowering the price on it to intermediate, even though the dynamics in here and the logic is super advanced and super powerful. So if you do want to buy it, it'll be at smarthelping.com. Right here under financial models, it'll be under the industry ones. I'll also list it at Eloquens and eFinancial Models. Uh, so look for it out there. Um, Now, it's going to be added in the SaaS bundle. So right now there's currently 9 that make up, like if you pay $289, you get all of them. I'm going to add it in there because some of this logic, like the churn and the way you're growing the count of each cohorts and or not growing it, but the way they're attaining quota and then having churn dynamically happen is it could fit into a SaaS model pretty good, or that logic might be useful if you're trying to build something else. So I think it's worth it to put in there, and I'm not going to raise the price of that bundle either. So, all right, that's all I got for you, and I will see you on the next one. This is smarthelping.com.